Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 21st of April. My name is Fook Hien and I'm your host for the podcast. In our latest weekly market view publication, we say that the Trump put is back in play. Another way of saying this is that after seeing the equity market fall by 20% peak to trough and seeing excessive volatility in the US government bond yields, President Trump is willing to step in to reassure the market. And he did this by pausing the US tariffs against major trade partners, excluding China. This 90-day pause will last to the start of July, and as most negotiations go, we may not get significant progress until we are very close to the deadline in early July. In the meantime, we believe this move supports our base case for a soft landing in the US economy. The probability of a recession has slightly increased due to the uncertainty of the trade war, but the US labor market and retail spending continues to be strong. We will, of course, closely monitor US consumption and jobless claims data in the coming weeks. Another key focus now is the US earnings season as we hear from company management how they see the economy now. We are still early in the earnings season and the data is changing every day, but as of the end of last week, the 18th of April, just under 12% of companies in the S&P 500 index have reported their results. The financial sector is the fastest in reporting results, and 34% of the financial sector have reported results, including the major banks. The financial sector has delivered a solid 8.1% positive earnings surprise, according to Bloomberg. With the banks, we saw strong performance in the capital markets, especially in equity trading. More importantly, guidance for banks' full-year earnings so far are not as bad as feared. Further interest rate cuts are expected, and that would put pressure on banks' interest margins, but this has been mostly baked into expectations. Loan growth can provide some offset to the interest margin pressure. And the outlook on loan growth is mixed. Some banks remain optimistic on corporate demand, while others are cautious given trade and geopolitical uncertainty. The banks also reported stability in loan loss provisions, which is reassuring on the state of US consumers and corporate borrowers. We believe US major banks are an attractive sector investment opportunity with deregulation prospects supportive of earnings and potentially even more share buybacks ahead. Meanwhile, in other industries in this earnings season, we see the airlines reducing capacity growth plans, especially for domestic US flights, as they become more cautious. Semiconductor companies are flagging the negative impact of US export restrictions and tariff uncertainties. We expect companies facing direct disruption on their supply chain to avoid giving financial guidance as the earnings season progresses. Consensus expectations are for S&P 500 earnings to grow by 8.5% in 2025, down from 10.5% 2 months ago, and we continue to monitor how this number evolves. Regionally, we see US equities as a core allocation, and we prefer to diversify our equities position globally across the US, Europe, and Asia. Within US, the equity sectors we like are the major banks and also technology software and communication services. That's all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a great day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.